All right, so a lot of people hear me talking about gap fills, gap fills, gap fills. Let's talk about how you can identify the gap fill, what it means, and how you can use this in your everyday trading arsenal. Very simple. There are very important hours to remember, right? The 9:30 open and the 4 p.m. close, because that is the bread and the butter. That is when the New York session is open. And that's what really matters when it comes to price action. The overnight moves do happen. They will affect the price, but the real volume, the real action is happening during the actual trading hours. And that's when a gap fill comes into play. So pulling up the chart here, this is actually the QQQ, which is an ETF that tracks the NASDAQ. You can do this on the NASDAQ, you can do it on the ES, you can do it on the SPY, but basically what we're looking to identify is where the market closed at on the previous day. We can see Friday, the market closed there at the 463s. All right, I think you see that. 463 market was closing there. Now, if we look at today's open, the market opened at about 466s. So there's this much of a gap, right? Pretty much from there to there. Obviously, if the market wasn't already open, you can kind of see by replaying how it would look. So basically, we would have this big gap in the price action gap, meaning that the market closed there on Friday. On Monday, we're opening up here. So there's a gap in the price. A gap in the price. Think about it. There's not a lot of volume overnight. The market doesn't have the same amount of kind of buyers and sellers trading all night long. So these gaps are very important. Why are they important? Because we want to identify these so we understand the price action. Do we have a lot of support here when we know that we gapped up overnight, but we really did not make this move during the normal trading hours? That tells me that there's a good chance that if we do pull back, we would fill the gap. So that gives me a understanding that the price action between here and there just really isn't strong enough to support this move. Now, I do want to make it very clear that not every single gap will get filled that very day. They say it's like 55, 56% of the time gaps get filled that very day. And then after that, it might be a week later, it might be a month later, it could be a day later. You don't really know, but we're always aware of those gaps. Something that I always look at every morning when I wake up. We talk about this throughout the course, the gaps getting filled and the idea of the price action, right? So the market opens up and you can see what happens. We end up popping up there, and guess what? Market's now open, it's open, and look what happens. The market fills the gap, pulls back into that low. The close from Friday bouncing there. I think it tested a little bit more. But look what happened after we retested that Friday low and we closed the gap. The market shot straight back up. So this is giving you two things to think about. It's giving you an idea for a short to the downside where your target can be, but also it's giving you an idea that if we do pop from here to back up to there, that there's a reason for that. And that's giving you an understanding that, hey, maybe don't keep shorting. Maybe don't keep holding on to the short. Take profit down here at this level. You got the Friday low there. You got the gap fill. Everything worked out. Take your profit. And there's a possible reversal coming off of this level. And as you can see, look, right back up. And what's funny is the market ended up now retesting that level once again. So we pulled back and retested that. So this gap is now turning into like kind of a range here. You got the overnight high now. You've got the gap all kind of playing out there. We had a gap the other day here as well. The market sold off. You can see the overnight, the close was down here, 458 level. And look what happened the next day. We did pull back, but we couldn't get all the way down there. So we just got like right to there. And that 459 thing, kind of like right there. If you're not trying to use the ETFs, the SPY or the QQQ, you can also do this very easily on just looking at the NASDAQ. Like if I pull up the NASDAQ right here, this is Monday. If I look at the close from Friday, where did we close at on Friday? Well, obviously we closed right here. And as you can see, we filled the gap there from the close on Friday on the NASDAQ. Same thing for the ES. Just looking to see where the market closed at the previous day. Do we fill that? Is there a gap above us, a gap below us? I believe that these areas that are basically, volume gaps or whatever you want to call it, the overnight gap, this creates kind of a speedy area or an area of less resistance or support, and vice versa. So when we get into these areas with these gap fill potentials, we see a lot of more kind of faster price action to fill that gap. We turn that gap into support. We bounce around. It becomes price action, looking at the levels and everything. But there really is something to be said about when there is a big gap in the chart, because a lot of times the price will kind of just search and kind of move and get to that point where it fills the gap very quickly on certain days. And then on other days, you might not get the gap fill. But we're aware of that. Same thing with all of this. If the gap fill is there and I see that the trend is starting to form and give me an idea of a break to the downside, like from here, for example, if I'm looking for a short from the VWAP here and I want to get this move down, well, I'm looking at this if we break to the downside here, there's a very good chance that we do what? We fill the gap, we hit that pivot point down there. So that's a real beautiful type of setup for a move down, because I'm getting confidence that the trend is going to want to push down. It's going to want to get down here and fill this gap, which it ended up doing. Because as you can see, even from here, from the 260s, we still had about a 100-point move to the downside to possibly fill that gap. And well, as you see, we got down there, we filled the gap, we hit the pivot point, and then we rocketed back up. So this, again, is telling me that if we start to sell, we're going down, I'm short. Well, guess what? I want to make sure that I'm taking some profit, I'm protecting my profit down here, because I know that now the gap has been filled. And you can see the shorts got squeezed, it pushes back up, and then again, starts to pull back there. If you're looking here, this is the 2-minute chart, the best possible entry for this break to the downside there. You've got this low there at open at the 930 to get that gap fill. Again, that 19,230 area right there is acting as kind of support and then turning into resistance. So your best bet of attack, your idea of attack would be to break this low. We get short for that move down to fill the gap down there to the 170, 160 area to hit down there to that pivot point. And as you can see as well, when you kind of get rid of all that, the low, the 15-minute opening range, remember, all of this stuff plays in together, right? The 15-minute opening range, the gap fill potential, everything is working together. And that's the great part. Think about this is we can put all this stuff together, and when everything lines up beautifully, when the gap fill is there, when the 15-minute range is there, when all this stuff plays out beautifully, you're going to get a lot more consistent, and you're going to really have those good A++ setups, right? A+ setups lead to A+ profits. And well, you got the gap fill, you got the VWAP, you got the pivot points, you got all that stuff happening. I'm looking at this as oh, that's primed and that is ready. And as you can see, we broke the 15-minute range there, 220s, and right down there all the way to the 120. So a 100-point move to the downside. Even if you didn't get that whole move, you got that pivot point right there. That's still, 70 points to the downside from the 220s. So beautiful setup. When those gap fills are there, be aware of them, identify them, have them on the chart. I'm always kind of just identifying these levels so that I'm thinking about it. I'm like, okay, all right, earlier I know that there's a gap fill. So if we do start to sell, I can be aggressive. I feel like this is a good chance that we hit that pivot point, we hit the gap fill, we're below the VWAP, everything is lining up beautifully, and it's giving me a lot of confidence to hold for a big winner and to also focus on the setup and to make sure that it kind of let it play out, let it do its thing, right? When I see everything lining up, A++, you got to take a trade. Even if you're taking a small size, take small size, but when you see these setups, when you see 5 or 6 things lining up perfectly, you're like, ooh, I got to get it. So there's the gap fill. Very simple. The market closes at 4 p.m. The very next day, it opens at 9:30. All the price action in between there creates a possible gap. If we're opening up, 300 points higher than we closed out the day before, well, obviously there's a gap in the chart. So look for the gap, look for areas of interest, the gap, the pivot points, all that stuff. It all is giving you an idea of where the price action, what the trend is doing to kind of get to that level, right? The market's moving. It's moving. It's trying to get to a certain level, and there's a reason that it's doing that. But what's the reason? Well, that is your question to ask yourself every time. You're looking at the chart. You're like, hey, what is going on here? Is there something that the chart needs to do? Is it trying to backfill a gap? Is it trying to hit previous support resistance? Ask yourself these questions. The more questions you can ask and answer, the less FOMO, the better the trades, the better confidence you're going to have in all of that very fun stuff. So the gap fills, keep an eye on them.